What is a company for? Is it a machine built for one single purpose? To make as much money as possible for its owners? Or is it something more? A citizen with responsibilities to its workers, its customers, and the very world it operates in? This isn't just a philosophical question. It's a trillion-dollar question that shapes our economy, our society, and our future. It's the central conflict in a quiet war being fought in boardrooms and on stock exchanges across the globe. This is the battle for the corporate soul. To understand this battle, we have to go back to 1970. The global economy was struggling. In the US, corporate profits were falling, and stagnant share prices had been the norm for a decade. A sense was growing that corporations had become bloated and inefficient. And in the pages of the New York Times Magazine, one of the most influential economists of the 20th century, Milton Friedman offered a diagnosis and a cure. His essay laid out an idea so powerful it would come to dominate business thinking for the next 50 years. It's known as the Friedman Doctrine, or more commonly, shareholder primacy. The argument was deceptively simple. A corporate executive, Friedman argued, is an employee of the owners of the business, the shareholders. Therefore, their primary responsibility is to conduct the business according to the owner's desires, which he stated is generally to make as much money as possible while conforming to the basic rules of the society. He famously concluded, and this is a direct quote, "There is one and only one social responsibility of business: to use its resources and engage in activities designed to increase its profits." To Friedman, a company spending money on social causes was, in effect, spending someone else's money, the shareholders, the customers, or the employees, without their consent. If shareholders wanted to donate to charity, they could do so with their own dividends. The corporation's job was simply to make those dividends as large as possible. This idea didn't become dominant just because it was elegant. It offered a clear, simple solution to the complex economic problems of the 1970s. It promised a return to focus, efficiency, and growth. And for decades, this gospel of profit became the undisputed creed of American capitalism. A philosophy so pervasive, The Economist once called it the biggest idea in business. But Friedman's doctrine was a sharp break from the past. For nearly 40 years, from the Great Depression through the 1960s, a different idea held sway: stakeholder primacy. This view held that management's responsibilities were dispersed among all of its constituencies, even if it meant a reduction in shareholder value. This older idea was given a modern, rigorous framework in 1984 by philosopher R. Edward Freeman. Freeman's stakeholder theory proposed a radical rethinking of the corporation. He defined a stakeholder as any group or individual who can affect or is affected by the organization's success. According to Freeman, a business is an interconnected system. Focusing exclusively on one part of that system, the shareholders, at the expense of the others, is not a sustainable long-term strategy. A company that underpays its employees, sells shoddy products to its customers, squeezes its suppliers, or pollutes its community will ultimately fail. The executive's job in this view is not to serve a single master, but to create value for all stakeholders and align their interests in the same direction. For years, this remained a powerful counter-argument, but largely in the academic world. Then, in 2019, something shifted. The Business Roundtable, a group representing the CEOs of America's largest corporations, including Apple, JP Morgan, and General Motors, issued a stunning statement. They formally redefined the purpose of a corporation. No longer was it just to maximize profits for shareholders. Instead, they committed to delivering value to all stakeholders, investing in employees, dealing fairly with suppliers, and supporting communities. It was a direct reversal of decades of shareholder-first policy. The challengers, it seemed, were now inside the castle walls. This philosophical debate has now entered the world of high finance through three letters: E, S, and G. E is for environmental. This looks at a company's impact on the planet, its carbon emissions, its policies on pollution and waste, its energy efficiency, and its exposure to the risks of climate change. S is for social. This covers how a company manages relationships with people, its employees, its suppliers, its customers, and its community. It includes things like labor standards, fair wages, data privacy, and product safety. G is for governance. This is about how a company is run. It looks at executive compensation, the independence of its board of directors, shareholder rights, and its record on ethics and corruption. So ESG stands for environmental, social, and governance. It's a framework that investors use to evaluate a company's performance on a wide range of non-financial factors. Think of it as the modern, data-driven application of stakeholder theory. The core argument for ESG is that these factors are not just nice to have, they are financially material. Proponents argue that ESG is fundamentally about risk management. A company with poor environmental practices might face huge regulatory fines. A company with a toxic work culture will struggle to retain talent. A company with weak governance might be vulnerable to fraud. A growing body of academic research suggests that companies with strong ESG performance tend to have better financial performance over the long term. Good ESG can lead to greater efficiency, foster innovation, and make it easier to attract capital from a rapidly growing pool of sustainable investment funds. The key innovation of ESG is its attempt to quantify these stakeholder concerns. By creating scores and metrics, it transforms a philosophical stance into an actionable investment strategy that can be applied at scale. This is why ESG-mandated assets are on track to represent half of all professionally managed assets globally. It's the operationalization of Freeman's philosophy, and it's why the debate is so intense today. But this explosion in ESG has triggered a powerful backlash, built on three main criticisms. First, the financial critique. Echoing Friedman, critics argue that focusing on ESG dilutes a company's primary mission, generating profit. By excluding entire sectors like traditional energy or adding layers of compliance costs, ESG investing may lead to lower returns for savers. While many studies show a positive link, the data is mixed and performance can depend heavily on the economic climate. Second, the data critique. There is no single universally accepted standard for what makes a company good at ESG. Different rating agencies use different methodologies and can produce wildly different scores for the same company. This confusion creates an opening for greenwashing, where a company can market itself as sustainable without making substantive changes. Tesla CEO Elon Musk famously called ESG a scam after his company was removed from an ESG index while an oil and gas company remained. And third, the political critique. This is where the term woke capitalism enters the conversation. Critics contend that ESG is being used as a tool to advance a progressive political agenda through the financial system, bypassing the democratic process. They see it as a form of corporate socio-political activism, where companies take stances on divisive issues that are unrelated to their core business. This brings us to the legal heart of the matter. Legally, corporate directors have a fiduciary duty to act in the best interests of the corporation and its stockholders. This is the legal pillar of the shareholder primacy argument. However, it's not that simple. U.S. corporate law is also governed by the business judgment rule. This rule gives directors broad latitude to make decisions they believe are in the corporation's long-term best interest, as long as those decisions are made in good faith and with due care. This creates a huge gray area. A board could argue that investing in renewable energy, while costly now, protects the company from future climate regulations, thus serving the long-term interest of shareholders. What this reveals is that shareholder primacy has persisted less as a strict, legally enforceable mandate, and more as a powerful social and cultural norm within the financial world. The battle, therefore, isn't just being fought in courtrooms. It's being fought in boardrooms, in proxy votes, and in the court of public opinion. It's a battle over the very culture and norms that govern corporate decision-making. So, we are left with two powerful competing visions for capitalism. One, championed by Friedman, sees the corporation as a specialized and highly effective tool for creating wealth. Its social responsibility is fulfilled indirectly by generating profits that shareholders can then use as they see fit, and by creating jobs and products within the rules of a competitive market. The other, articulated by Freeman and embodied by the ESG movement, sees the corporation as a powerful social actor with direct responsibilities to a broad set of constituents. In this view, sustainable, long-term wealth creation is not at odds with these responsibilities, but is entirely dependent on fulfilling them. This is not a debate with a simple right or wrong answer. It is a fundamental, ongoing negotiation about the role of business in 21st century society. The battle for the corporate soul is not about choosing a winner. It is about how we, as investors, employees, customers, and citizens, decide to navigate the inherent tensions between value and values, between profit and purpose. This debate is far from over. Which perspective do you find more compelling, and why? Share your informed thoughts in the comments below. And if you appreciate deep dives into the biggest questions in finance and business, be sure to subscribe and hit the bell for more.